If you've already heard about the most common methods for reducing your tax bill, such as RRSP contributions, tax deductions, and tax credits, and you're looking for new ways to pay less taxes, this video is for you. Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about 6 lesser-known ways to legally pay less taxes in Canada. We'll go over 2 ways to legally pay less taxes if you do not yet own a home. 2 ways to legally pay less taxes if you already do own a home. And 2 ways to legally pay less taxes regardless of home ownership. At the end of the video, I'm going to share an important tip that could save you thousands of dollars in taxes. It's related to the new capital gains tax announced in June 2024. So let's jump right in. If you do not yet own a home, you have access to 2 key ways to pay less taxes that the rest of us can't use. The first is the new FHSA. Whether or not you actually intend to buy a home, you should definitely make use of this plan. Let me explain. First of all, with the FHSA, just like the RRSP, you can deduct the contributions you make from your total income for the year. This allows you to save on taxes immediately. For example, if your income for 2024 was $65,000 and you made an $8,000 contribution to your FHSA, you would save over $1,600 in federal taxes alone. Second, the FHSA can stay open for 15 years, which is plenty of time to earn investment income tax-free, just like in a TFSA. Third, if you never end up buying a home, you can simply transfer the money to your RRSP, tax-free, and without affecting your RRSP contribution room. This means that you basically get an extra $40,000 in RRSP contribution room that the rest of us can't have. If you'd like more information about the FHSA, my detailed video all about it is linked in the description box below. The second way to legally pay less taxes as a first-time home buyer is by claiming the home buyer's amount. This tax credit allows you to claim up to $10,000 for the purchase of a qualifying home, which results in a $1,500 reduction in your taxes. For example, if you owed $10,000 in income taxes, that amount would be reduced to $8,500 using this credit. Next, we'll look at 2 ways to legally pay less taxes if you already own a home. The first way is to ensure you live in your home for at least 12 months before selling or renting it out. This is because the CRA introduced a new rule in January 2023, called the Residential Property Flipping Rule. The rule basically states that, if you own your property for less than 365 days before selling it, you'll pay taxes on 100% of the profit you make, as if it was business income. Normally, you would be able to claim the principal residence exemption to offset the capital gain and not pay any taxes at all. Now, why did I mention that this rule also applies if you rent out your home? Because the CRA considers that changing the use of your home from principal residence to rental property is the same as if you had sold it. So, the residential property flipping rule applies if you begin renting within less than 365 days of owning the home. For more information on this, be sure to check out my video on the subject, linked in the description box below. The second way to legally pay less taxes, if you already own a home, is by optimizing your principal residence exemption. This exemption is what allows you to avoid paying taxes on the capital gain when you sell your principal residence. To be considered a principal residence, you have to own the property and have ordinarily inhabited it during the year. Based on the CRA's definition, you could actually have more than one principal residence at a time, such as your regular home, plus a cottage. So, what exactly do I mean by optimizing the exemption? Well, even though you can have more than one principal residence at a time, only one of the 2 can be designated as your principal residence per year when claiming the exemption. This means that you'll pay the capital gains tax on one or the other. To make sure that you pay the least amount of taxes as possible, you need to optimize the exemption. You do so by calculating the annual capital gain for each property and designating the one with the highest annual gain as your principal residence. I'll be making a video detailing this process in the future, so be sure to subscribe and hit the bell if you want to be notified when it's released. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Finally, let's talk about 2 ways to legally pay less taxes, regardless of whether you already own a home or not. First, use your TFSA as an investment account rather than as a savings account. This is the biggest TFSA mistake most people make. A savings account typically gets you around 1% in interest per year. On $5,000, that's only $50 of income. You don't want to be using a tax-free tool, like the TFSA, to save taxes on only $50. It's a waste. On the other hand, when you invest your money in things like ETFs and stocks, you can earn a lot more. The average stock market return, over the last 30 years, was close to 10%. This means that, by investing the same $5,000, you would earn about $500, or 10 times more than in a savings account. It's much more advantageous to make $500 tax-free, rather than only $50. If you'd like more details on the TFSA, I've linked my video all about it in the description box below. Last but not least, another way to legally pay less taxes is by converting non-deductible interest charges into deductible interest. But, what exactly do I mean by this? Basically, if you pay interest on personal debt, such as a credit card, you can't deduct the amount on your tax return. However, if you pay interest on money which you borrow to earn investment income, the interest charges are deductible. Let's go over an example to see how this could work. Let's say you have a $5,000 credit card balance at a 20% annual interest rate. That's $1,000 in interest which you need to pay, and it's not tax deductible. Now, let's say you also have $5,000 of investments. You could sell your investments and use the money to pay off your credit card, saving you the $1,000 interest charge. You could then get a line of credit from your bank for $5,000 and use the money to make new investments. The interest your bank will charge you for this line of credit is now tax deductible, because the money is being used to earn income. However, keep in mind that this is an advanced strategy with many variables involved. For instance, it will not work if your money is invested in a tax-sheltered account, such as a TFSA. It also only works if you're going to be earning interest or dividends from your investments. It doesn't work if you're just waiting for your investments to increase in value to cash in the profit. Also, remember that you'll need to pay back the full line of credit even if your investments lose value. So, definitely speak with a financial advisor before going ahead with this strategy. Alright, now that we've gone over 6 lesser-known ways to reduce your tax bill, I'd like to share a final tip that could save you thousands of dollars in taxes. As you might have heard, the CRA increased the inclusion rate for capital gains from 50% to over 66% in June 2024. This means that we'll be paying taxes on up to 66.7% of the profit when we sell capital property such as real estate, instead of on only 50% of the profit. Luckily, individuals like you and me get a $250,000 threshold before this new rate applies. And that's where my tip comes in. Due to this threshold, it becomes advantageous to buy real estate with another person, such as your spouse, because the capital gain will be split between the two of you. Let's look at an example. Let's say that you buy a rental property 50-50 with your spouse for $600,000, and you eventually sell it for $1 million. You would have a capital gain of $400,000. But because you own the property 50-50, the profit will be split between the two of you, so $200,000 each. Since $200,000 is below the $250,000 threshold, the full amount will be included at 50%. For a grand total of $200,000 in taxable capital gains between you and your spouse. If, instead, you bought the property alone, you would have to include $250,000 at 50%, plus the remaining $150,000 at the new rate, which would result in over $225,000 in taxable capital gains. That's a $25,000 difference compared with 50-50 ownership. For more information on how the capital gains tax works, be sure to check out my video linked in the description box below. So there you have it. We discussed 2 ways to legally pay less taxes if you do not yet own a home. 2 ways to legally pay less taxes if you already own a home. And 2 ways to legally pay less taxes regardless of home ownership. I also shared an important tip that could save you thousands of dollars in taxes, related to the new capital gains tax announced in June 2024. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.